Hello friends, today I tell you what is a debt. Debt is the amount of money borrowed by one party from another, typically to make a large purchases or investments that cannot be paid for immediate. It involves an agreement where the borrower must repay the lender over time, often with interest. Debt is a common tool used by individuals, business, and governments to finance projects, expand operations, or manage cash flow. Key components of debts. First, principal. Principal means the original amount of borrowed. Second is the interest. The cost of borrowing money usually expressed as an annual percentage rate. This is a profit earned by the lender for providing the loan. Third is a term. The period over which the debt must be repaid. For example, 5 years, 30 years, 50 years. Fourth is the installments or payments. Regular payments made to repay the principal and interest. Payment can be monthly, quarterly, or annually depend on the loan agreement. Fifth is a collateral for secure debt. Collateral means an asset placed by the borrower that the lender can seize if the borrower default on the loan. Sixth is a default, failure to repay the debt as agreed, which can lead to penalties, legal action, or loss of collateral. Next is a type of debt. First, personal debt, credit card. Credit card is a short-term borrowing with high interest. Mortgage, the long-term loans to purchase real estate. Auto loan, loans to purchasing vehicles. Next is a student's loan, debt taken to financial education. Next is a personal loan, unsecured loan for various personal expenses. Second is a business debt. Second is a business debt. Business loan, financial for business expansion or operations. Lines of credit, flexible borrowing for short-term business need. Next is a bond, debt securities issued by corporations to raise a fund. Third is a government debt, treasury bonds or bills, debt instruments issued by governments to finance public spending. Municipal bond issued by local government or municipalities. Secure versus unsecured debt. Secure debt is a backed by collateral, lower interest rate because the lower risk to the lender. Unsecured debt not backed by collateral, higher interest rate because the higher risk. Good debt versus bad debt. Good debt means increases value or generated income over a time. For example, education loan can lead to higher earning potential. Mortgage can appreciate over time. Business loan can help grow the business. Bad debt used for depreciating assets or non-essential spending. Example, credit card debt accrued on non-essential items. Higher interest pay debt loan, costly and difficulty to repay. Why the people and organization take on debt? First, to finance large purchases, buying home, vehicles, or starting a business. Second, to expand operations. Businesses borrow to invest in growth opportunities. Third is a cash flow management. Debt help cover a short-term expenses during a cash shortage. Fourth is a leveraging opportunities. Borrowing to invest in appreciating assets like a real estate, stocks. Risk of debt. First, over borrowing lead to financial strain and difficulty to repayment. Second is the interest accumulation. Higher interest rate can significantly increases the total repayment amount. Third is a credit score impact. Failure to repay can damage credit score, making future borrowing difficulties. Fourth is a legal consequences. Difficulty can be lead to set a siege or bankruptcy. Managing debt effectively. How to manage a debt effectively? First, budgeting. Ensure monthly payments are manageable within an income. Prioritizing higher interest debt. Pay off high interest loan first. Consolidation. Combine multiple debt into a one lower interest loan. Emergency fund helps avoid taking on debt for emergency. Debt, when used responsibly, can be a powerful financial tool. However, mismanagement can lead to long-term financial difficulties. Thank you.